Where are my trades? They should be visible. One moment, I will figure it out. I gotta save it here. Awesome. So this was a trading mistake. I bought at the trend line, and for some reason I sold out. I didn't want to sell out, but I don't know exactly why that happened. What my train of thought was yesterday, but it was a mistake. I would want to hold all the way up, and my take profit was up here somewhere, to a test of the channel high. Let's make it here. But why didn't I hold it, and why did I sell out? You see, the approximate channel I drew in here was in waning momentum. We have pushes um, that are losing strength from here to here is not comparable from here to here. So you see the market was missing strength, was losing strength. This is why I pretty much sold out when the market returned on me, and I initiated a short and wrote it a little down. You can figure out my entries yourself. So this was the first trade, was a mistake. I sold out too early, but bought in again with about a point of loss, uh, and then I sold out first up here, then down here, and then when the retest, I bought this bar, and this is where the short video I made yesterday, I didn't like how this bar was moving. I had a take profit up here, but it wasn't hit again. Um, so my first profit target was missed by a tick or two, and this profit target also. And then I was getting a little emotional, and this is where I pretty much stopped my trading for the day with with the profits I had. But it wasn't. I hadn't a lot of time yesterday, so this was a reason to. Um, Great. So you see, overall, not a bad day. Um, it was the right decision to sell out because right after then we got this huge bear bar, and now I will now get rid of this stuff. Where are we? This huge bear bar, and this would actually be a signal bar for a breakout, obviously, of this channel here. How could we see this? We are in this trading range, and if you see the weekly chart, we already were in a downward sloping trading range. This is approximately the test of yesterday's high, and the high body test. uh, no, sorry, I'm wrong day. This is approximately a um, downward sloping trading range, and this was the test of the trading range yesterday, uh, like I thought when I made the video. So then we got the breakout to the downside, which I unluckily was unable to take. So what I mentioned in the short video in the matrix style is how a trader sees the market, how I see the market, and I will now just break it down what I was talking about yesterday's video. So this is a wedge. Why is this a wedge? Because we got 1, 2, and 3, and this is this wedge shape. 3 pushes down, and with this wedge shape, we were forming a double bottom in a upward sloping channel. And as a few of you maybe know, in the channel we often have three pushes up before it reverses, and this could be 1, 2, and 3, or how you may count it. So I was very aware that we may be in for a reversing, because we were breaking down of this channel here. So this was the first wedge. Then we double bottom. Then we have also here a kind of triangle move, and triangles also are known to be possible final flags. What I mean by that, final flags are the last breakout that may come to an upside, and you see we have a two-legged move here upwards, and this two-legged move was very good tradable, because we have also with this move a retest of a rough retest of this body lines. If you make the trading the range shape from the bodies, you see it was a clean retest, and you could have also a micro leg 1, leg 2 move also here with this breakout. Again, you just buy and hope for a measured move, and it got hit there. This was also a good trade, would be yeah. So these are all possible ways to see the market, and I will go and continue further. So we have this wedge, breakout from the wedge, also breakout from the triangle, but we have another things going on here. We have, if you want, we have a trading range here with a test of the range there, and test of the range here, and also tests of the range here. We got a breakout of the range, and another range there. We got a breakout of the range to the downside, and the retest of the range, which I was making in a short video, a retest of the high, and when this bar was staggering here, I just sold out, because I wouldn't want to have the risk. It was planned as a scalp. I didn't want to hold for leg 1, leg 2 move here, because we're already in the late stage of a trading range, and I was aware of overall market structure, which was downward sloping. So then if you have the market open, you could say we are in a ranging state here as well. So these are all possible approaches to the market, because you have here this choppy, here's choppy. Some people call it a thick area where market is prone to reverse and reverse all the way and time again, and into comparison of a thin area where market is just going through. Yesterday, not yesterday, because the day of yesterday is this day, and this is the day before yesterday. The levels are still in effect, so you see a clean last week's low, first rejection, and then we got a clean cut through yesterday's low, tested it again here, and also last week's low. You see here, this would be a gap. This is a sign of market strength, but we are not that further. We are still in this range, and see what was going on here. So, and this is a wedge down here. This is also a wedge up here. Where is this brush? So we have 1 push, 2 push, and 3 pushes. This is also a wedge shape, and this would be considered a wedge top, like this was a wedge bottom. This is a wedge top and a double top, and then we were entering. Say one thing. You see a very nice wedge top, double top. When you consider line charts would only display the closes of the bar. So in a line chart bar, you would have a very clean double top with the closes of the bars, and so people trading off a line chart would see a very nice clear double top, also a failed breakout of this triangle, and a reversal down. Then we have why did I take this trade? we have a tight trading range, a tight trading range down. In a tight trading range, you would only take the high probability trade, and the high probability trade is a limit order entry short, because it's sloping downward, right? And it's always easier, not easy, but easier to take the with trend entry. What I also was mentioning in the video was from this double top, a retest, which was actually a double top pullback short again. So if you have missed the first entry, which was up here, which obviously a lot of people took below this bar because you see the selling pressure. After this bar, the second bar, which consolidated the double top and also the wedge. So we have two signals actually here that indicate a short. There was a lot of selling going on, and it closed not really well, but below the double top. So if this happens, you would expect a measured move from the double top. You can take it measure here, down here, or if you be more conservative from the line chart perspective, you would take only the closing here, down here, and you would get filled here. So if you only took the double top trade, this would be your entry, and you could have first taken some profits here and then leave the rest in. This was a double top pullback, a retest of the high, but again it was a weak retest. You have 1, 2, and you call this a third push because it went above. Again, you don't see it on this time frame, but let me try this. If you go on a 1 minute time frame, let's assert ourselves here. This is the double top, and on a 1 minute time frame, you see this is a nice wedge shape here with 1, 2, and the third push. So you can say a micro wedge if you want, but it's still a wedge. And also the entry, if you missed the first entry, you could have a limit order entry at your entry bar, and you would not get filled, but a little below. You would get filled on the body, and you would surely get filled beyond the bar. So this is a lot of traders took this entry as well. At this signal bar, you would place a stop order down here to enter. I already told that I believe this would be a stop order down here, or you could simply sell at the close of the bar, which would be the aggressive approach. But as you like, is your approach as a trader, the stop would be well beyond the channel, but this would be still a great risk to reward ratio. Why? So if you took the market order trade and placed it well below, beyond the range, and went for down here, it was a 1 to 2, 1 to 1.3, and even a 1 to 5 would get filled. So this would be a well-structured trade. If you took the breakout from the trading range and went for a 1 to 1, you would get filled as well. This is the high probability trade, because you already had a lot of selling pressure, but you could reduce your risk when you wait for the retest in the wedge. And then this was this wedge down. I labeled it a wedge, 3 push pattern, 1, 2, 3. You could also argue that this is not a 3 push pattern. If you consider this still part of the trading range up here, you can say 1 and pull back through a complex two-legged move where the first leg is divided into 2 legs, and the second leg starting here divided into 2 legs. So you have a 4-legged move, but it's still easier to take the complexion away and still say the two-legged move. And this is where I first got in. I already told you, because of time restrictions, and I wasn't able to wait for the 9 o'clock, but I was well aware before that I was trading right before market open, and this is why I got out. So it wasn't possible for me to stay in the trade because I was with my full position on 5 contracts, and you don't want to be with a position in a market you know that may be doubling in the size of the bars. You don't do that with FOMC meetings. You don't do that with London market open, and you rarely do it when New York open starts, except you are with a swing trade in a strong trend. Then you could leave the trend open and rely on your stop. So you see how you will read the market over time, how your read of the market will begin to evolve after time. If you just see this, it's unstructured, but over time, and you have a market structure on your side, and you gain the knowledge, you will make sense out of these lines, and it will get better. It took me about 3 to 4 years now to read the market in the way I do, but I don't consider myself there yet. I will surely need a few more years, a couple of more years to be at the point where I want to be, and probably won't ever be on a point where I say I figured it out, because you're always in a kind of gray fog. You never know exactly what is happening. So there are patterns evolving, and you need to assess quickly and constantly think which outcome is more probable. I plan on doing a video on this too, but you see here we have a trading range, and if you start trading the market around this point, you can say, yeah, we have a leg 1, leg 2 move. This maybe, if this is strong, could go further. So you won't be able to just short at this line, because this line would present itself like this. You would take the mirrored line and put it up here, and you see obviously this was not a good approach. You had a short order up here somewhere. So if you're trading this trading range where the high probability trades, was the second reversal here. Like I said before, you trade only the trading range. The higher probability trade was trading all the way to a retest of the channel bottom, and the low probability trade would be a breakout to the upside, because in an upward sloping channel you won't bet on a breakout to the upside. This is the low probability bet, but you could still do it if there was at least a 1 to 5. At least a 1 to 5. So you could structure this trade in a way, and this is what I mean by trading in probabilities. If you structure this trade like there, a breakout from the double top reversal, so a failed double top here, then you would probably, this is, I wouldn't take this trade. Let's just do it for the math. So 1 to 5. Still 2. Somewhere here. If there was room up there, or 1 to 5. If you take this trade 5 times, you probably will get roasted 5 times. But if you think in probabilities, you can take this trade. So if you get one winner, uh, I probably think this is a very low probability, so 20%. So if you have an 80% cash overflows, you can take this trade and still be fine over time, but I wouldn't do it. So this is what I think in probabilities. This is the very low probability event. So trading in probability means always structure a trade in a way that you can take it 100 times and still make money. And therefore, it's very essential to know your probabilities. And there's no way around it. You just need to master your style of trading and I don't like the term strategy, but you can call this strategy if you want. And if you have your numbers in mind and you know what to do, you can structure a trade that is a probable winner, but you obviously have a low win rate, but a huge win at this kind of trades. But even then, I wouldn't take this trade because it's the worst possible entry. You would take this trade down here somewhere. That's a lot better risk to reward ratio, and the 1 to 5 is more likely. But even, yeah, you know what I mean. So great. Well, that's it for today. I will start my weekend and be away from making videos probably, except I have a great idea for a short. And wish you all a nice weekend and have a great day. All the best. May the